Think about debt for a second. Could you name a country or union that is debt-free? Is it difficult to do? The same goes for the EU. The European Union's outstanding debt totals over 14 trillion euros. That's an astounding 82% of their overall GDP. And guess what? This debt has the potential to increase. But how on earth did the EU and its members accumulate such tremendous debt? And how do they intend to settle all of these debts? Which debts does the EU itself and which do its member nations owe? What rules does the EU have in place to combat debt? The fact that there is debt is critical since it can directly affect the value of the euro. For example, if the EU's debt grows, the euro's value against other currencies falls. This is because increasing amounts of debt can make investors less willing to invest in the currency, causing its value to fall. On the other side, if the EU properly manages and reduces its debt over time, it may have a positive impact on the euro's value, as lower debt levels make the currency more appealing to investors, increasing demand and therefore value. When the euro is strong, all member states benefit from increased trade and economic prospects. Something similar occurred when investors became concerned about the financial crisis and refused to lend money to certain countries due to the increased risk. Instead of lending, investors wanted higher interest rates for taking on that risk, making it even more difficult for these countries to repay their current obligations. It was so difficult that these countries were unable to deal with these difficulties on their own or even under national oversight. So they sought assistance from outside parties such as the Eurozone neighbors, the European Central Bank, ECB, and the International Monetary Fund, IMF. This problem resulted from a balance of payments crisis. This occurs when foreign money abruptly stops pouring into countries that rely largely on it and are running large deficits. That is not all. The common currency of the euro exacerbated the situation because these governments were unable to lower the value of their national currency as a solution. They couldn't simply devalue their currency to make things simpler. Yes, devaluing their money could have been the solution, but imagine being a flourishing country and having your currency lowered due to someone else's mistakes. It is not fair, and the EU was on a mission to mitigate such hazards. And how did some Eurozone countries accumulate so much debt while others did not? It dates back to when the euro was originally introduced. There were pre-existing discrepancies between the economies of the Eurozone countries, and these gaps played a significant role in the growing debt. The European Central Bank opted for an appealing interest rate, which some may consider a wonderful opportunity. This shift benefited investors in the northern Eurozone countries, increasing their interest in lending more to their southern counterparts. Why wouldn't the South take advantage of this? The low interest rates made borrowing almost impossible to resist. The idea was that this would make the South more rich. However, over time, this arrangement led to an increasing deficit, primarily from private players in the economy. As a result, the low interest rates designed to promote the economy pushed these southern countries deeper into debt. Perhaps this was the problem. Even if 20 of the 27 EU countries use the same currency, they do not owe a common debt. There are no EU bonds. Each EU country issues its sovereign debt, which means it has distinct financing costs based on how well it manages its public finances and economic potential, even though it uses the same currency as the other member countries. Investors view strong economies such as Germany and France, which have stable public finances, as less risky. Countries with weaker economies and higher levels of debt, such as Italy and Greece, make riskier investments in bonds. The interest rates that investors in each country demand reflect this risk differential. Countries with lower risks, such as Germany, can borrow at cheaper interest rates because investors have greater confidence in their capacity to repay the debt. In contrast, higher-risk countries, such as Italy, must pay higher interest rates to attract investors. Even though the EU members do not have a common debt, they do have mechanisms in place to assist one another during times of crisis. The European Stability Mechanism, or ESM, was established as a safety net for Eurozone countries experiencing financial difficulties. Essentially, it acts as a rescue fund for member countries that are unable to borrow from the market at acceptable rates. For example, when the COVID-19 pandemic struck, the European Union took a daring action. They introduced the novel Next Generation EU initiative. It's a one-time joint debt insurance plan that will last until 2027. The goal was to financially support the recovery from COVID-19 and make fundamental changes to the European economy. Now, catch this. They funded it with $860 billion. Incredible. Unfortunately, not everything went smoothly. The cost of borrowing has been rising, making EU officials hesitant to borrow more. In addition, the EU has implemented norms and regulations governing member nations' debt levels. These provisions are collectively known as the Stability and Growth Pact, SGP, which was implemented in 1997. The SGP requires member states to keep their budget deficits below 3% of GDP and their public debt at no more than 60% of GDP. This is to prevent countries from accruing large amounts of debt, which might lead to financial instability and risk for the entire Union. However, these rules have been criticized and challenged in recent years. According to some, the Eurozone crisis of 2009-2012 serves as evidence that they have been unsuccessful in preventing financial crises. Others believe that the standards are overly rigid and do not account for external circumstances like economic downturns or natural disasters. In response, the EU revised the SGP, incorporating a more flexible approach during times of crisis. For example, in 2020, because of the COVID-19 epidemic, member states were permitted to temporarily exceed the 3% deficit limit while receiving financial assistance from EU initiatives. Some argue that the future course appears clear and that issuing Eurobonds is the only way to gain control. However, this has become somewhat of a banned phrase in the corridors of power in Brussels and Berlin. Northern European nations, which have lent money to others, find it difficult to believe that their southern counterparts will handle their finances appropriately. These countries have expressed reservations about pooling their debts and are concerned about the rising costs of borrowing money. Additionally, there won't be any additional debt problems after the 2058 repayment deadline for the EU's next-generation EU plans debt financing. Because there will be insufficient supply, the EU's debt markets may be smaller, deeper, and slower to trade than those of the large member nations. This, however, could raise costs because a large number of easily transferable secure assets are essential for investors. As a result, we are left with a complex issue and no apparent solution. While pooling debt appears to be an excellent solution, the anxiety and uncertainty surrounding it make it difficult to sell to Northern European governments. Without those countries on board, the EU's borrowing rates may continue to grow, making it difficult to fund critical projects and investments. This might have long-term consequences not only for the EU's economy, but also for its global reputation and ability to compete with other big economies. However, one thing is certain, we will keep you updated. So subscribe to our channel for more information about the European Union and its economy. Thank you for watching, or